Hi, good morning, everyone. Thank you for joining us this morning. Today, we have quite a full table of counters that we're going to go through. A lot of results, as well as the initiation of UG Healthcare, as well as banking update and Singapore Weekly. So I'll just jump right into it. Starting things off with Keppel DC REIT. So this is Keppel DC's one half results. So on the positive side, we note that there was no out-of-pocket rental rebates that were offered to tenants, and there was a 2.8 million in savings upon the attainment of tax transparency for Keppel DC 4 in Singapore. So KDC managed to attain this tax transparency within 7 months, and it was within the estimated 6 to 9 month gauge based on past applications. There was also early lease renewal negotiations that reduced FY21's lease expiries from 10.7% to 6.2% by NLA. On the negative side, there were delays in the AEI and development timelines due to the lockdowns in respective countries. So I think on the in figure 1 on the left, you will see these are the AEIs as well as developments that are ongoing. In Australia, in Telecentre 3, there were constructions were able to continue despite the lockdowns, but for Dublin as well as Singapore, there were construction has paused because of the lockdowns. In Singapore, presently, construction is still suspended due to governmental policies on foreign workers residing in dormitories. A negative, but actually this is not really a negative, gearing increased by about from 30.7% to 34.5%. And this was due to the acquisition of Kelsterbach DC. However, we view this utilization of gearing headroom favorably because KDC has a very healthy interest coverage ratio of 12.8 times. So on the outlook, we note that KDC actually has several third-party acquisitions in discussions. However, acquisition timelines were thwarted by traveling restrictions, and which led to difficulty in viewing the assets. Additionally, the increased demand for data centers will increase the potential buyers and may lead to bidding up of prices. So overall, we still maintain a neutral on Keppel DC with a higher target price of $2.57. And this higher target price is attributed to a higher terminal growth that we have incorporated of 2%. Previously, it was 1.5%. So we increased the terminal growth rate to better reflect the historical pace of DPU growth. For the past 5 years, the CAGR has been about 2.7%. So we're factoring in a slightly lower 2% growth in our model. So while we like Keppel DC for its futuristic characteristics of data centers, the DPU yield of 3% is on the low side, while the price to NAV at 2.44 times is relatively rich in our view. So we'll move on to CapitaLand Commercial Trust. So in the first quarter of 2020, CapitaLand Mall actually retained about 69.6 million worth of taxable income. However, in the second quarter, they actually released 1/3, which is amounting to about $23 million worth of distributions. So on the positive side, we note that tenant sales actually fell by a smaller magnitude of 15.4% compared to footfall, which is currently at about 40% of the normalized January levels. So this stronger performance in tenant sales was due to the performance of supermarkets, which was up by about 18.6%. And not to mention, CapitaLand also launched an e-commerce platform, which is called eCapital Mall, and an online food ordering platform called Capital Treats on the 1st of June. So this was able to help tenants capture some sales and add it to tenant sales. CapitaLand Mall also managed to eke out 0.1% rental reversions in the second quarter of 2020. This compares to the reversions in Q1 of 1.6%, so it's slightly lower. So reversions were a mix with downtown and suburban malls both clocking in positive and negative rental reversions. There was also about 2% worth of NLA that were not renewed in the quarter. So current expiries for the rest of the year is about 7.6% by GRI. And occupancy remains relatively high at 97.7%, although it has come down from 99.3% as of December 2019. So we are expecting a softer leasing environment for the rest of the year. On the negative side, the amount of rental rebates increased from $114 to $154.5 million. And this rental rebate actually comprises the rental waivers from landlords, as well as the property tax rebates, cash grant from the government, and the additional rental relief to qualifying SME tenants based on the new rental relief framework for SMEs. So this increase in the rental rebates was actually largely due to the cash portion, the cash grant by the government, which will be passed on to the tenant. Additionally, we note that portfolio valuations fell by about 2.5%. If you include the JV, which is Raffles City Shopping Centre, or rather Raffles City Trust, valuations were fallen by 2.7%. And these lower valuations were registered across all malls. And just to give you some color, the revaluation changes were about 0.6% for Junction 8, and it ranges all the way to the highest downward revaluation, which was 4.8% for Clarke Quay. We'll move on to the next slide, which is on outlook. So currently, about 95% of CMT tenants are operating, and shopper footfall has actually recovered to about 53% of January levels as of the first week of July. And while there are stronger and weaker performing malls. So for the suburban malls, some of the better performing malls actually register up to 80% of normalized footfall. Yeah, and for downtown malls, right, the footfall ranged between 40 to 55%, averaging 45%. So apart from offering rental deferments, CMT has also selectively offered lease restructuring for their tenants as a more holistic solution in dealing with this uncertainty from COVID-19. So on average, CMT actually collects about 3 to 5 months worth of security deposits from tenants, and they allow tenants to draw down on 1 month's worth of security deposit for to pay rents. And so this leaves about 2 to 4 months worth of security deposits as a safety net. Our target price is unchanged, $2.33, and FY20 and 21 DPU presents 5.8% and 6.3% yield. Moving on to Frasers Centrepoint Trust. This is their update, 3Q update. So on the positive side, there was only 4.8% of NLA left for renewal this year. And rental reversions for the third quarter were actually positive, although the actual numbers were not disclosed. Leasing environment remains weak. However, the management did share that there has been some demand from F&B tenants. So compared to CapitaLand Mall Trust, shopper traffic for the second week of July actually improved to 61.1% of last year's levels. And the lower traffic in July was largely due to safe distancing and traffic density measures, which are currently still in place. And similar to CMT, 95% of tenants are presently trading. So across the suburban malls in FCT's portfolio, shopper traffic was less pronounced at Changi City Point, which relies more on office crowd from the Changi Business Park area, and also lower for Anchor Point and Bedok Point, which housed fewer essential services, for example, your supermarkets, compared to the other heartland malls. On the negative side, portfolio occupancy fell by 1.5 percentage points quarter on quarter and 2.2 percentage points year on year to 94.6%. So occupancy was weaker across all malls, led by Bedok Point, which was lower by 3.7 percentage points, UT Point, which was lower by 2.6 percentage points, and Causeway Point, which was lower by 1.2 percentage points. On the outlook, FCT has dispersed about $25 million worth of out-of-pocket rental rebates year to date, and as such, they have fulfilled the mandated 2 months of rental waiver under the rental relief framework for SMEs and qualifying commercial tenants. And currently, FCT still retains $18 million worth of distributable income in their books. So we actually slightly increased our forecast to incorporate the additional 12.07% stake in PGIM ARF that was acquired in June, and our DPU for FY20 stands at 4.1%. Moving on to CapitaLand Commercial Trust. So CapitaLand Commercial Trust, they actually retain some $6.4 million of distributable income in the first quarter. However, if you look at our table under 1H, you can see that all distributable income has been released. 129.32 it has been released in DPU. So on the positive side, portfolio occupancies remained unchanged at 95.2% quarter on quarter, and there was a very meager 3% worth of leases that were signed or renewed in the quarter, and this 3% of the portfolio NLA that was renewed or new leases was lower due to the difficulty in showing the spaces due to the lockdown. Sorry, that being said, there was still some positive rental reversions, which ranged 0.4% to 26.1%. FY20 refinancing is completed, and that lowered the average cost of debt by about 0.1% from 2.3% to 2.2%. On the negatives, portfolio valuations fell marginally by 1.7%, and this was largely due to lower market rental assumption as well as rental growth assumptions that the valuers incorporated due to the economic uncertainties from COVID-19. There were some construction delays, and this will push back the viewing as well as the leasing activity, particularly also for WeWork and some of the AEIs at 6 Battery Road. And so an update on Capital Spring, the construction for Capital Spring has resumed. So moving on to outlook, while we still expect modest positive rental reversions, we think that they are still achievable. This is because average expiring rents for FY20 to FY22, they range $9.08 to $10.95, and this is lower or under market in comparison to the current market rents, which are about $11.15. So out of pocket waivers, rental waivers constituted about 35.2% of the 25.8 million in rental waivers committed. So actually a large portion of this 6.48 million was due to the 60% share of Raffles City Trust, and only 2.6 million rental rebates was actually for CCT's tenants in their books. For the German portfolio, which comprises of Galileo and MAC, it remains resilient with no rental waivers granted. So we continue to view office space favorably, favorably, and we think that offices will remain relevant in the evolving world of technology and telecommuting. The value added by office will evolve from being merely a physical workstation to a space synonymous with mentoring, collaboration, corporate culture, and creativity. So there are no changes in our estimates, and CCT offers FY20 yield, estimated yield of 4.5%. Next will be Ascendas. So this is their one-half results. DPU was largely in line. It formed about DPU of 7.227 cents formed about 44% of our FY20 estimated DPU. On the positive side, out-of-pocket rental rebates was only 2% of FY20 revenue, bulk of which went to Singapore tenants, about $20 million, 0.6 million to Australia, and 10 million to US tenants. There were no rental rebates offered for the UK tenants, although Ascendas REIT did allow the tenants to pay rents on a quarterly instead of a half-yearly basis. The REIT also managed to achieve positive portfolio rental reversions of 4.3% for the second quarter, bringing the 1H rental reversions to 5.4%. So average rental reversions were about 4% for Singapore, 16.6% for Australia, and 16.2% for the US. REIT is pushing ahead with their acquisitions and AEIs. They announced 2 acquisitions year to date, 25% acquisition of Galaxis, which is a business park in One North area, as well as a logistic asset under development in Sydney, Australia. There have been 8 AEIs announced to date, 4 of which have been completed in the second quarter, and another 4 have been announced during this result season. On the negative side, we note that DPU actually fell by 10% year on year, and this was largely due to the larger unit base, which increased by 16.3%. when A-REIT acquired their portfolio of business parks, US business parks, they actually raised a higher proportion of equity. Hence, the unit base was increased by a larger amount. And also, of course, rental waivers of 20 million and the absence of rollover adjustments that resulted in a lower DPU. We maintain an accumulate for A-REIT with a higher target price of $3.63. We adjust our estimates to reflect the acquisition of the 25% stake in Galaxis, as well as the acquisition of the Australian logistic assets. So our higher TP is actually largely due to a lower beta assumption, which lowered our cost of equity from 6.4% to 6%. We continue to favor Ascendas REIT due to asset geographical as well as tenant diversification. Their very large portfolio of $12.75 billion comprises 197 portfolios spanning Singapore, Australia, UK, and US. Additionally, while the price to NAV is relatively on the high side at 1.6%, the low cost of borrowing and this NAV at a premium actually positions A-REIT for more acquisitions. So moving on to the last REIT counter, which will be Ascott Residence Trust. So for A-REIT, on the positive side, we note that there are about 843 million in cash and credit facilities that are on standby, and this is sufficient to cover the operating fixed cost for 2 years. So we also note that ART's interest coverage ratio deteriorated quarter on quarter from 5.1 times to 3.6 times. However, we feel that the cash and credit facilities in place will help to weather this period of depressed earnings. There were alternative sources of revenue that helped to fill occupancy. So in the 1H, the occupancy was 50%, and this was 10 percentage points higher than in the first quarter of 2020. So international travel bans are largely in place. However, ART was able to tap these alternative sources of revenue, such as government bookings for quarantine facilities, temporary facilities for healthcare, and COVID-19 responders. So I will show a table later on to show the assets that actually benefited from these kind of alternative revenues. We also note an erosion of stable revenues as 4 of the French master leases and 3 of the UK management contracts with minimum guaranteed income were renewed on variable terms. So this figure actually shows the RevPAR performance in the key markets that ART has a presence in. As you can see, all are red except for Singapore, which actually benefited from a lot of the government contracts and COVID-19 related alternative revenue. And this figure actually shows you the assets that benefited. So for in Singapore, right, Somerset Liang Court benefited, as well as Park Hotel Clarke Quay and Citadines Mount Sophia. So on the outlook, recall that ART's master lessee, which is WBF Hotel and Resorts, they're actually the master lessees of 3 Japan properties, and they have filed for civil rehabilitation, which is i.e. bankruptcy, on the 27th of April. And these 3 properties are located in Osaka, 2 of which are closed, and they make up about 1.8% of ART's valuation. There were 3 months of security deposit that was held by Ascott. However, that has been utilized as of July. And Ascott is currently still in negotiations with WBF as well as other operators, including their sponsor, the Ascott Limited. So, so they're in discussions to, as of how to continue operations and to take over if necessary. In July, Ascott also entered into 2 conditional agreements to divest Ascott Guangzhou and Citadines, the asset in Paris. So these 2 proposed divestments are viewed favorably, and they are at about 52% and 69% above their respective book valuations. And these I think the negotiations for these sales took place before COVID-19. So overall, we maintain a buy on Ascott with a lower target price of 1.08 cents, and we lower the revenue to recognize a slower recovery of international travel, the extension of the 4 French master leases, as well as the 3 UK MCMGIs on variable terms, and the sale of Ascott Guangzhou and CADMP, which is the Paris asset. So I'll pass the time on now to Wee Guang for Raffles Medical Group.
Okay, thank you, Natalie. So right now we're talking about Raffles Medical first half results. Okay, so on the positive side for Raffles Medical, they saw their healthcare services revenue grew 6.8% year on year from 116 million to 124 million in the first half of 2020. So this was because Raffles Medical actually assisted the Singapore government with air border screening at Changi Airport, swabbing foreign workers at dormitories, and even providing medical services to COVID-19 patients at the Changi Exhibition Community Care Facility. So this served as a replacement income for the slower business momentum observed within the first half. However, on the negative side, we see that in terms of hospital services, it actually fell 5.4% year on year from 148 million to 126 million. This is because some of the hospital services actually encountered business disruptions across China and Singapore within the first half. So we know that in the first quarter of 2020, China was first hit with the coronavirus outbreak, and moving into second quarter, it was Singapore who went into the circuit breaker. So in the second point, there's also a low operating margin of about 10% in the first half observed compared to 13.6% in a year ago. So this was due to higher staff costs and purchase and contracted services due to the manpower demands when they actually undertake these initiatives to help the Singapore government with combating the COVID-19. This was partially offset with the job support schemes, higher wage credits, and property tax rebates that the group received during the first half. However, we do note that for them, they actually did mention that for the job support scheme, it was not really an entire replacement of their cost, because although not only is it capped at $4,600 per worker, because they are mostly professionals, the pay usually is much higher than 4.6%, so they are not even replacing 75% of the cost for manpower wise. Okay, in terms of outlook, we see that the group has observed that there's a gradual return to normalcy across both China and Singapore. So patient load is actually returning to pre-COVID-19 levels. However, they did not mention roughly how much of the pre-COVID-19 levels was it now. However, the full return to normalcy will be contingent on cross-border travel restrictions, as foreigners make up about 20-30% of revenue in Singapore, while China also serves a significant portion of expatriates in. So margins will look set to return to previous levels with higher contribution from inpatient services. So things like hospital services where people actually book in to the hospital. That's when we will see higher margin contributions as well. Secondly, there is a setback to operations in China. What we saw was that because of the outbreak in China in the first quarter of 2020, Raffles Hospital Chongqing is expected to delay their break-even by 1 year due to the lower patient load. And for Raffles Hospital Shanghai, although it is already currently in the final stages of outfitting and expected to begin operations at the end of financial year 2020, but any resurgence to the COVID-19 cases in China itself might push this timeline backwards. So this will further push back the gestation cost. So we are currently maintaining a neutral call with a revised target price of 94 cents. The earnings estimate was actually revised downward by 25% after taking into consideration the business slowdown that we observed in the first half of 2020. Okay, next up we have Singapore SGX. So for SGX, generally they delivered a good set of results, nothing much to pick on. For the positive side, we saw that cash equities business sees sustained retail participation in the fourth quarter. So for them, the quarter ending 30th of June was actually their fourth quarter, and we saw that their trading and clearing revenue was up 48% year on year from 44 million to 65.8 million. So SGX did note that the new retail CDP account openings were up 40% year on year from 45,000 accounts in 2019 to financial year 2019 to 64,000 accounts in 2020, financial year 2020. So, however, with the general, there was the entire trading activity was heightened across all business segments, just that we see more contribution from retail segments now. Secondly, the data connectivity and indices business actually grew 40% year-on-year in the fourth quarter due to their scientific beta acquisition in the third quarter. So scientific beta actually contributed 14 million in the second half alone after the acquisition in January. The full year contribution in financial year 2021, so from the next 1 year, will provide the inorganic growth within the segment itself. So if you are just looking at 14.4 million in one half, so by right, it should add about 20 million. It should add about 20 million to 28 to 30 million for the financial year 2021. And the next good thing that SGX actually announced was that they actually increased their dividend from 7.5 cents per quarter to 8.0 cents per quarter. So moving forward, they are looking to hold this dividend rate steady, barring any unforeseen circumstances, of course. And this will represent a 7% increase year-on-year. In terms of negatives, generally nothing to pick on, just that the current market conditions is still not very good for capital raising activity. So we saw that listing revenue was down 5.2% year-on-year, and corporate action revenue was also down 27.5% year-on-year. Okay, in terms of outlook for SGX, we see that they have made some strategic acquisitions to lay the groundwork for the future growth. So in the third quarter of financial year 2020, the acquisition of scientific beta will add new capabilities to the company by catering to new investor demands such as smart data investing, ESG investing, which will be the next trends in investing in the future. And within the past quarter, following up on the scientific beta's acquisition, SGX also acquired the remaining 80% stake in BitFX. So this marks their entry into the FX OTC market to complement the current suite of products. So although currently BitFX in terms of market share itself is very small, about 5% in terms of the daily average value traded, daily average volume traded. However, this will give them a bit of organic growth in the years to come, because their current CAGR is about 57% per annum over the past 3 years. And also for SGX itself, this provides some cross-selling opportunities whereby they can sell some of their FX futures products to the BitFX clients and otherwise. So secondly, there is an active management of products to ensure business longevity. So in May, when SGX actually announced the MSCI product license cessation in February 2021, they actually launched a new set of products with FTSE to replace the MSCI products that is expiring in February. Currently, there's only the FTSE Taiwan product, which is the biggest product that they are replacing from the MSCI suite of products. However, they are expected to launch an expanded suite of products that will be bigger than the MSCI suite of products, and they will be ready for distribution in the US, unlike the MSCI products. So we are upgrading SGX to a buy with an upward revision in target price to $9.45. So our target price actually pegged to 21.4 times PE ratio, which is one standard deviation below the 5-year average. So current prices are trading at an attractive valuation of about 18.5 times, which is more than 2 standard deviation below the 5-year average. Okay, so just a quick banking update. I think last Thursday, MAS actually made an announcement to urge dividend cap on the local banks and trying to cap their dividend at 60% of the financial year 2019's dividend per share. So we are trying to understand what impact it will have on the banks itself in terms of capital adequacy ratios. So we look at the CET1 ratio. On the first line, we see that the respective banks' 2019 dividends are issued. And then what we expect is we put a cap of 60%, which is the first light blue row of 72 cents from DBS, 78 cents from UOB, and 32 cents from OCBC, which is expected. And then we see that there's a savings on the first yellow row. So what happens is we took their previous CET1 ratio and we tried to see if the previous CET1 ratio were to hold true and they had not given out any dividends in 2019, what would their CET ratio be? And this gives us the final row of the change in CET1 ratio if they had not given out any dividends at all in financial year if they had not, if they had saved 40% in dividends in financial year 2019, they would have saved about 0.5% in their CET1 ratio. So instead of the 14% across the board that we saw in 2019, their CET1 ratio would have been about 14.5%. However, this is to note that they are actually targeting their operating CET1 ratio to stay at about 12.5%. So there is a fair leeway for them to fall before, in terms of to increase their credit costs before they need to take more drastic actions. So after this 1 year, we are expecting that they will resume their higher dividend payout. And that's it from me. I'll pass the time on to Paul for the UG Healthcare Initiation.
Oh, okay. One slide back. And where's the background slide? Do you all miss? I know there's a missing slide. It's okay. And then move back to UG. Okay. Anyway, sorry, I wonder there's a missing slide as usual. But anyway, for UG, we initiated coverage on UG. What the company does, which is the missing slide, is it produces the disposable gloves. And also what's the difference between them and the other glove makers is that UG has roughly around 55% in latex, which is a natural rubber, and whereas compare someone like Riverstone, it is all nitrile. And also the other thing is they have 85% of it is their own branded, whereas if you see if you compare with the big guys like Top Glove or Hatta Lega, there are many called OEM glove makers. So when they have a customer like Kimberly Clark, okay, this is the slide. When they have a customer like Kimberly Clark, so if you can look at the third bullet point, 85% of their sales is under their own brand name. Whereas if they have their own company, whereas if you compare with the big guys like Top Glove and Hatta Lega, they sell more on the OEM model. So maybe a vendor or a distributor like Kimberly Clark will just ask Top Glove, can you produce glove for me under my own brand name? So that's one of the difference. So as a result, so UG have thousands of customers. So maybe a dentist, or I'm just pulling a customer, a dentist, or maybe a tattoo artist can ask them, can I have like 1 or 2 boxes for today? So they don't have, so they will just distribute to these such customers. So as a result, of course, the downside of it, you have to spend a lot of money upfront. You have to build warehouse, you have to keep stock, and in the beginning, it's always painful because all these are additional costs. So as a result, what has happened the last 2-3 years, UG's numbers were hit because they have to spend a lot of money to invest. But now I guess it's paying off. The other difference for them is they have distribution centers, so they're quite strong in certain countries, like Brazil. Sorry, you can't really see on the map, but Brazil, they're strong there because they have to set up, and you need locals to sell. You can't bring a Singaporean to Brazil to go and sell these gloves, or Malaysian. So they're strong in Brazil, UK, Germany, and China. Okay, next slide. Okay, anyway, I will just move on. In terms of the next, slide is actually our investment thesis. So our investment thesis for UG is firstly, as we all know, the lead times. The lead times are basically is the order. So before COVID happened, I think we mentioned this before. Before COVID, when you make an order for gloves, you will only get it 1 month later. But right now, it has actually shot up to 12 months or even more. So basically, it shows there's a shortage of gloves out there. The other thing is that the factory spot prices has also surged. They used to be roughly, depend on country, $25, but now it's about $120 per 1,000 piece. So some of the reason what happened is that when the pandemic hit, all the gloves by healthcare just mopped up. All supply were available up there was mopped up. Of course, what has happened is that when there are more patients in the hospital, regretfully, then you obviously will have more usage. And of course, with the awareness, the frequency of the use. So if you're a healthcare worker, you use more gloves, more frequent. Maybe you use once a day. I'm just pulling a number. Then now maybe they use 3 to 4 times a day. So as a result of this, there's been a spike in demand. Then of course, other industries are also using, especially airlines are now using, although there are no passengers now, but eventually when the demand comes, all airlines or all crew members have to wear gloves. Okay, the other you look at the bullet point number 2. So the other part is that unlike OEMs, they capture the higher margins. Of course, you get the distribution margins, not only the manufacturing, you also get the distribution margins, and of course you can realize the full selling price. Whereas if let's say you are an OEM, you only sell let's say $25 in the past. Then whereas if you are a retail, you can sell at $30, $40, or $50. So that's the difference. Okay, and the other third bullet point, which is probably the more important point, how long will this shortage continue? I mean, no one has the exact crystal ball, but when we look at the numbers, we think that the shortage could last even until end of next year. Anyway, the first point, behind the scenes, even before this COVID, the demand for gloves in some of the emerging countries like China, Brazil was really low. As you can see, China used 10 and Brazil 24, but whereas if you look at Europe and US, they're like 10 times more. So Brazil population, I think it's 200 plus, I can't remember, but they import less gloves than maybe someone like UK and so forth. Okay, the other point is that before COVID, demand for gloves was roughly about 30 billion. I mean, don't ask me how they get the 30, this is just an estimate by the Malaysian industry. I mean, I'm not sure they're going to count 300 billion. So every year the demand was 300 billion and it was growing about 30 billion a year. But we think this year, 2020, the demand could jump by 60 billion, 20%. And something to support it was also the Malaysian exports is actually up 20%. So we got some inkling as the demand. And then next year, if you go back to the trend growth of 10%, you're looking about 33. So for the next 2 years, demand, let's say roughly about 93 billion. But the supply response to this is only about 74. This is based on my estimate. I'll show you a chart later. So even if you assume, and 74 is the capacity, and most of them cannot hit 100, so let's say you assume 90%. So you're only going to hit about 60 to 70 billion, whereas demand is 90. So that's why we think the demand, the shortage could even persist into 2021. And of course, with COVID, still many countries still having troubles trying to contain it. It looks like this thing could continue. Okay, next slide. Okay, I know that's the demand supply. So if you look at the left chart, the red line is basically the net demand. So as you can see, the 60 there. So in 2020, which is this year, we think demand could rise by 60 billion. Then 2021, 33. It used to be 30 billion. If you look at 2019, it's about around 30 billion. So demand was up to 60. That's how we got the demand number. So in terms of the left chart, it is the supply. So if you look at these are all the announced capacity. Of course, some are not listed, and so that's under others. So if you total up all the supply announced, UG, Top Glove, we get 229 billion gloves. But they are roughly around the 85% of the world output, roughly Thailand and Malaysia, because we have 3 trunk numbers there. So the net increase basically roughly about 30. Then you add from other countries, or even some of the smaller glove makers that are not here. Some listed Malaysian smallers. So we came up with a rough number about 34 billion this year and 40 billion in terms of the demand, the supply that's coming up. So even then, like we mentioned, demand next 2 years 90 and supply is only about 70. So the mismatch continues into 2021. Okay, in terms of our valuation, how we came up to 15 times PE. And what we did was we did a 40% discount to how UG. UG has been listed since 2014. So if you take the average, the average discount to the listed peers, so that's UG's PE in red line. It swings up and down. And the 5 largest, I mean, not the whole, but the 5 largest operators, 5 largest PE for the top Malaysian and also Riverstone. That's the one. So the difference is usually about 40%. Of course, recently, if you look at the beige chart, the PE discount to peers, it of course rising to even 60 because UG's numbers wasn't that good the last 1-2 years because they were investing in the distribution, building warehouse and so forth. So that's how we came up with a 40% discount. This is our last slide. But we think our forecast about 30 plus million for FY21, there is some upside to the numbers. We already built in some buffer. Okay, the reason is that, as you mentioned earlier, the prices of gloves have gone up maybe 5 times. But if you look at our estimate of our ASP, again, this, because they don't have production number, this is just ASP on the capacity that they've announced. So we forecast about this year maybe 30 over dollars, Sing dollars, and then next year maybe around 40 over dollars, roughly. But you know, the prices have doubled, so there could be some upside there. And of course, cost of production is flat, and I think cost is actually falling because it's in our report anyway. But you know, rubber glove prices, all prices, synthetic rubber or nitrile gloves is made of derived from oil or butadiene, and that is also down. So as a result, cost is actually flat. So as a result, you know, every dollar you increase in price, it goes straight to the net profit. So that's why the earnings can jump. And this is just my last slide. Last chart is on the glove exports. As you can see, the Malaysian exports in the red line is now about 19.6, about 20% growth year on year. So the growth is going to be high, and this is on metric tons. So we're not sure the number of gloves because they don't really disclose. Okay, that's it from UG. Next slide. If you go to Sheng Siong's second quarter results, obviously the numbers was amazing. You can see revenue was up 75%. So if you look closer at the numbers, so what drove the numbers obviously is if you see the bullet, the number SSG, so that means same store sales growth. So it means growth of a mature store, maybe the store that was in Ang Mo Kio, anything older than 2 years. So that store itself, those old stores, the sales grew about 60% year on year. Then of course, contribution, net contribution. Then of course, the new stores also have supported growth. So that's the reason why sales shot up. So that's why the positive, of course, was the sales was actually better than beat our estimate. The other positive was gross margin. Gross margin was 28. They used to trade about 27, but this quarter, the gross margins hit 28.1. It's a record. Not so much of product mix. As you know, the big story for Sheng Siong was always they sell more fresh and the margins was better for fresh. But this time around, margins was because there was less promotions. Obviously, Sheng Siong probably more worried about trying to fill the shelf, trying to get the worker to put enough product on the shelf rather than putting a discount since it was flying off the shelf. So obviously promotion not a priority, and that's why they hit record. Obviously, this can't sustain. I think you can see promotion starting to come back. The other positive on the results was the huge cash pile. They hit at 222. Just to give you some context, last year it was 83 million. But again, there was some nuances or some timing things. The delayed payment of taxes because of the government support, and also the dividends because the delayed AGM. So the number won't be so high, but even then it will still be a record level. And as a result, the dividends they doubled the dividends to 3.5 cents to keep their 70% payout ratio. You can see from the table. In terms of the negatives, I mean, there's really nothing hard to go and find a negative, but the only thing is the stores. They're going to open 5 stores this year, which is going to be good. I mean, it's still going to support 8% growth. So at least we know next year there's at least a baseline of 8% growth. But the only thing, the second half, they mentioned that there may not be that many award of HDB stores. I think with the whole COVID, obviously HDB has more things to worry about than to open a store. So that could actually slow down for next year, like the following few years kind of growth. Because if there are less stores now, then it might impact more on next year. In terms of outlook, the demand will still be elevated. Of course, the pantry loading, the hoarding up, less people, probably my wife don't have to stock up so much toilet roll. So obviously the pantry loading that happened since during the circuit breaker won't happen again in second quarter, but the demand will still remain high. The main reason why demand will still be higher than pre-COVID levels is because more people are dining in home, dining by household. So obviously that will be strong. On gross margins, actually there should be a comma. On gross margins, it should normalize around 27% as the promotions return. And the strength of Sheng Siong again is the convenience of they're very close to all the neighborhood centers. I mean, that's why the malls are more affected. Less people go to the malls to buy groceries compared to a Sheng Siong, which is more conveniently located. But although we like Sheng Siong, but we're downgrading it due to the price performance and the valuations. And mainly because when we pack the valuations for Sheng Siong, we cannot use this year's earnings because it's it's like we mentioned, like turbocharged by COVID. So as a result, when we benchmark it to FY21, we usually use 25 times PE, which has been their average. Then we get about 165, which is around current levels. So that's why we are downgrading it to neutral. Nothing about the company or how good they are. It's just the valuations, and we just have we're not very clear what is sustainable earnings as we move into 21. So that's why we are downgrading it to a neutral. Okay, move on to a weekly and next time. In terms of, our weekly, we usually just give you some of the highlights, what we think are the more important macro. So Wee-Kong will share more in his report, but in terms of the banking, loans growth was very weak, actually pathetic. It was 0.2. It's the slowest loans growth that we have in the banking sector in 17 years. Employment, of course, we got a big hit, 130,000, one of the worst in decades. The other number that we got, a macro number, is in Thailand. So the liquor sales, we were actually quite surprised it weakened again. Maybe me was a bit of hoarding, and that's why it affected June. But as a result, I think Thai beverage numbers won't look good in the second quarter. I think only May was good. The April, as you remember, for Thai beverage, April there was a ban in liquor sales. Then May it rebounded. Then now June is again weak. Okay, and then the only good number coming out was in China. So China's macro numbers was really good. The PMI was 51. I think like the fourth or fifth consecutive month of increase. So in terms of our tactical views, very, very short term views, a bit cautious. Of course, it doesn't help when some genius decide to ask everyone to cut dividends. But anyway, we're a bit cautious. And I think we're just nervous, not so much for Singapore, but in terms of the economic momentum slowing down in the US. And of course, the lack of positive drivers. What we mean here is that with all the fiscal, even if the US announced the fiscal stimulus, that 1 trillion or 1.2, we're not sure whether it can move the markets. So unless there's some visibility in the pandemic breaking down, I think it will be a bit sluggish in the near term. But what we like is the US REITs. I think the US office REITs, we think they're the most resilient, and as we are looking for dividend cover now or income, we think US REITs will probably be the best for now. But back to Singapore, I think the worst is over, but the recovery will be gradual. I mean, we did speak to a construction company just now. So I think, again, they share the same sentiment. The worst is over and things are starting to unwind. Activity is coming back, but it'll just be very slow and gradual. So in terms of the week ahead, I think you can leave it for you to read, but we do have webinars, and again, if you do sign up for some of our listed webinars. We have a menu live tomorrow, then Singapore Pain Care, which is IPO, OUE Commercial REIT, and we have First Sponsor. First Sponsor is interesting because they seldom come out to meet, but as you know, First Sponsor is owned by Quat Lim Bing and Tai Tak. As you know, Tai Tak is one of the big shareholders of UOB, so they got a very strong parent. But anyway, they are a property company, and if you want, can just dial in because they seldom do hold these type of events. So you just have to click on the link and just sign up for those events. Next slide. Okay, nothing much. This is our usual COVID watch. We're now becoming COVID watchers. As you can see, the good thing is the US numbers starting to taper down. Still high, but at least starting to slow down in terms of the infections. The of course globally is still high, and we can see in Manila. And you look at the table on the right, even China is starting to creep out a bit. Again, it's not alarming numbers, but we do see some creeping up. So we are facing the second phase, third phase kind of situation. The good news is Singapore. I think if you look at the most important is the red line, the 7-day moving average. Our community cases is now down to 3. It's hardly anything, probably more dengue, obviously. So that is good because what it means is that the easing of the lockdown, so economic activity can start to return to Singapore. I think this is even lower than before the relaxing of the phase 1 and second June. So these are very positive for the Singapore economy that we are starting to improve again. Next slide. Nothing much. That's the activity just for reference. Next slide. Okay, these are our employment numbers. I think it speaks for itself. I think what more worrying is the services. It's hitting services more, and obviously this is not good for consumer demand in Singapore. Yeah, and then next slide. Okay, this is nothing much. This is just to show you the Thailand situation. The only good thing is that it's rebounding, but we just worry very near term the numbers will disappoint everyone. Although everyone already brought down the numbers, but it will be a bit disappointing. The right hand side, we always show the farm income index. This is basically, as you know, for Thai beverage, 90% of their earnings come from spirits, and spirits all drunk by I mean, not drunk, it's consumed by farmers. So that's why the income levels are quite important. Next slide. Okay. Anyway, I know. Sorry, this is a bit confusing chart, but we do get a lot of questions by people on how the U.S. unemployment affects the U.S. REITs. So this, although our NS have recovered, I just wanted to show you another way to look at it. So just bear with it. So from January to June, this is the number of payrolls. So as you can see, if you look at the non-farm payroll, so the number of workers that lost their jobs in the US from January to June, pre-COVID to right now, is about 14 million. You can see the minus 14. But most of it actually comes from the leisure and hospitality. As you all know, the hotels and so forth. And of course, retail is down. So retail, leisure, almost 40% or close to half of all the losses come from this area. But if you look at Manulife's tenants, you look at legal, finance, retail. Retail for Manulife is actually, and one of them is Amazon. So I'm not sure why they put it retail. But anyway, so you look at legal and finance, the decline in legal and finance is not that as drastic. It's about 5, and you can see the number of workers is really low. And real estate finance is hardly anything. Real estate is minus 2. So what I'm trying to say is that in terms of the job losses, Manulife and Prime, in terms of the industries they are the most sheltered. And of course, most of them are actually multinationals, the large corporations. So there's another level of safeguard. I mean, they're not immune to it. Obviously, they might get hit, but it won't be as drastic as the headlines that you see, like leisure hospitality. 1/3 of the workforce just disappeared. And, finance hardly anything is -1. Data processing is IT. The information that you see, the -11, a lot of it is actually media and so forth. So what we're trying to say is that they are relatively sheltered because their tenants are not in the epicenter of the job losses. This is our Phillip FCT, our model portfolio. We more or less move in line with the market, which is not great. I think we were hit by some names like Ascott, but we still like them, and of course some of the property names. What supported our performance was the venture, of course. Okay, on the bottom right, just one last point for me. The bottom one is just to show you the performance. Commodities did well, I think mainly because of Vilma. So the market is just moving according to selected names for last month. And of course, healthcare was all the rubber glove guys. And of course, industrial REITs was Keppel DC and so forth. Okay, anyway, that's it for us. Any questions? Feel free to type in. Thank you.
Okay, I think I'll go. Sorry, hello. Yeah, I think I'll go first with the questions. I think there's a few questions for me. First of all, there's a question whether I have actually factored in the SGX potential loss of the MSCI clearing revenue from next year. So, okay. So first of all, we need to understand that the management did provide a guidance of about 10 to 15% impact on revenues as a result of the MSCI cessation. But what we see is that, first of all, because they actually guided for the full year, but because the cessation itself only happened in February, which to SGX is their second half of financial year 2021. First of all, this was first cut, we get a much more muted number compared to the 10 to 15% that is expected by SGX. Then secondly, what we see is that the contract that they have with FTSE to launch the FTSE Taiwan Index is actually replaces more than I think 70 or 80% of all the because under the MSCI contracts that they have, that SGX has, about 70 to 80% of it is the MSCI Taiwan Index futures. But right now, because with the new FTSE Taiwan Index futures product that they have launched, they are able to replace the income they will lose from the MSCI Taiwan Index futures using the FTSE Taiwan Index futures. And what more, that they are able to launch an expanded suite of products even before the cessation of the MSCI contracts before February 2021. We are expecting this loss in income from MSCI contract to be more than replaced by the new FTSE contracts. Okay, then I think there is there's also another question on what do I think of the 60% dividend cap? How long will it go for, and why is MAS talking about it now, and whether there's any particularly bad loans for the local banks to be expected in the second quarter? Okay, first of all, in terms of bad loans, none of the banks have flagged out anything, and we didn't see any particular names being flagged up during the quarter of huge specific losses that will likely to incur, specific provisions that will likely incurred by the banks. However, for the 60%, so what I'm thinking is the 60% cap will most likely affect it only in the short term. So right now they are thinking of capping it for 1 year. If we were to take precedence from what happened in 2008 global financial crisis, that was when the banks also cut their dividends in 2009. They also only cut for about 1 year, and right after 1 year they are able to bounce back, and that was when the financial sector itself was hit the hardest. I think right now we will slowly start to see the impact creep in on the banks. So I think the current savings will help for the future when maybe the loans deterioration the loans quality deterioration will start to show itself maybe at the end of the year. But in terms of the upcoming quarter results, I think most of it has already been expected by the market. And I think there was another question on 3 Singapore banks have dropped quite a bit. Was it due to the cut in dividend announcement? Would it be a slow recovery? So yes, I think partially a large part of the drop in the Singapore banks prices was because of the cut in dividend announcement, because I think a lot of investors are actually bought into the banks looking at their dividend yield and saying that, hey, this is a very attractive yield, about 5 to 6%. And right now, once it is cut to about 60% of what it was in 2019, it is only providing a yield about 3.5 to 4%. So of course, it is still quite a modest amount, 3.5 to 4%. But compared to what they were expecting of about 5 to 6%, it is a bit off. So of course, they will try to rotate out their funds to go into something that is better yielding if they're looking for yield-specific investments. And I think there's also one on the perspective of Singapore banks, whether there's any analysis on the quality of the loan portfolio. In this, we are forecasting as with the guidance of the bank. So I think most of the banks are guiding for credit cost to increase to about 3% from non-performing loans ratio to increase from about 1.5% to about 3%. So we have actually taken that into account when we forecasted our earnings.
Hi, I will take the question on Ascott. So I think there was a question asking about what's the difference between ML, MCMGI, and MC. So ML stands for master leases. MCMGI is management contract with minimum guaranteed income. So these two lease types are the more stable, so to speak, lease types, where master leases, there's a fixed amount stipulated within the contract of how much the property will get. And usually, especially for the UK funds kind of assets, right, there will be this fixed income will grow at a rate that is pegged to the inflation. For MCMGI, as the name says, minimum guaranteed income, there's a floor income here. So that means if the asset performs better than expected, ART will get a portion of the revenue. Otherwise, if everything hits stuff hits the fan, then what you get is the minimum guaranteed income. So these are deemed like stable kind of revenue sources. Then for management contracts, this kind of lease type, ART is responsible for the entire profit and loss. Meaning to say, the occupancies, the daily room rates affect Ascott. It will form the revenue that Ascott gets, and then Ascott will pay out staff costs, etc., capex to maintain the assets. So management contracts are the more variable kind of lease types.
There's a question on Jaffa. Sorry, we don't cover. Maybe we'll try to listen in to their results and try and update if you ask again. So sorry for that. US markets. We don't hard for us to comment for US. If you want a later 1 p.m. we have our US chartist you do charts on the US. You can actually refer to that part.
There's a question on in your Phillip Absolute 10, the CapitaLand, is it referring to, basically it just refers to CapitaLand Limited, the sponsor.
Okay, I think there's a few more questions from my side. What are the chances for a major tech company to do a primary or secondary listing in SGX, given that SGX has entered into an agreement with Nasdaq? So I think, first of all, the agreement with Nasdaq, although it's with a very big name, but I think it was met with some pessimism. People don't really know what this means for SGX itself, and they did not really disclose any potential. They didn't really disclose anything related to the Nasdaq agreement. But right now, it does seem that SGX is actually moving quite actively into their multi-asset platform. First of all, with the acquisition of BitFX, it seems that they are trying to put more effort into the OTC FX market segment itself. So I think because right now, it has always been the largest market out there. Yeah, so most likely this is where their growth will hinge on in the next 1 year. However, any new news that we will receive from them with regards to the contract with Nasdaq, yeah, will definitely be welcome. Okay, I think there was also one where someone mentioned, wouldn't the banks raise their dividend payout slowly from year end and to stretch it over the next few years rather than a big jump back to the FY 2019 payout levels? For this, I believe, if I'm not wrong, although the news says MAS urged the local lenders to cap their dividends at 60%, I think it is immediate, kind of like an immediate effect. And the banks have also actually put out some announcements. For example, like DBS, they have already mentioned that they are over the next 1 year itself, their payout will be capped at 72 cents. So this is compared to the previous year, which is at $1.23. Yep. And so I think the 60% cap is a hard cap, at least for the next 1 year.
I'll take some questions too. Okay, so one question is about what's the outlook for S-REITs, medium term, 6 to 12 months, and longer term virtual trends. So for virtual trends, I'm assuming you mean, for example, telecommuting, as well as e-commerce. So I think very obviously, data centers are the ones that will benefit, are the beneficiaries of this COVID situation. In terms of the greater usage of content in general, and due to telecommuting. Apart from that, in terms of, for example, how in terms of the effect of telecommuting on the demand for office space, that will be more we view it, in our view, that will be more of a structural change. While Singapore is a country that typically does not really utilize working from home, we are more of a work from office kind of society. I think in this period of time, we believe that decision making is with regards to leasing will take a back burner seat, and companies will reevaluate their needs for space, etc. And hence this the threat of telecommuting it will be more of a structural, gradual change. And in terms of, for example, e-commerce, Singapore is one of the countries where e-commerce is not, e-commerce penetration is not as high as you would see in Australia or in the UK. I think this is to do with our city-like, demographic. Yeah, in that sense, e-commerce, the threat that it plays on retail, as well as now the demand for logistic assets. I think in future the demand for logistic assets will continue to be relatively strong, and for retail, the demand for retail space, or the leasing with regard to retail space, that one is more tied to, we would say, the health of consumer spending, and we do believe that in the short term, at least, there will be some sort short term meanings, within the year, we do actually expect vacancy rates to go up. slightly. Yeah. Actually, similarly for office space also, we also do think that in the near term, there might be some higher vacancy rates. Yeah. But in the long term, the space, or rather the new supply of space coming onto the market is relatively tight. So I think that keeps that helps to keep and also the government can also control the new spaces, the land sales, government land sales. So that will help to keep a baseline on things and support for rents in the longer term. There's another question on financial impact of for Ascott if COVID-19 were to prolong for another year. So within our estimates, actually, we are projecting a recovery, although not to 2019 levels, for FY21. So we're expecting a recovery, but for it to be slightly below the 2019 levels. So that being said, of course, if COVID-19 were to prolong, it also depends on whether or not the vaccine is found, which I think once the vaccine is found, which the timeline was supposed to be in a year or so, I think that will definitely give people or consumers the confidence to travel. And definitely there has been a lot of pent-up demand for traveling. So if COVID-19 were to extend, I think, and for example, if a cure, a vaccine was not to be found, then probably you'll see numbers, such ugly numbers from Ascott, I think, in 2021. Oh, sorry. There's one more question. What's your recommendation within the retail REIT space? So within our coverage, I think we cover CMT and FCT. We like them both. We have both buy and accumulate for FCT. So for FCT, I think it's more of a, we like them because of resilient domestic necessity spending in their heartland malls, their suburban malls, which are located near transportation nodes. We see organic growth in terms of catchment size growth around their three largest malls, Causeway Point, Northway Point, and as well as Waterway Point. And there's also imminent inorganic growth, which is the acquisition of the PGIM ARF suburban malls for them to be acquired by FCT and injected into FCT's portfolio. So we like FCT for these reasons. And so also in terms of valuation, I think CMT is also currently presenting very attractive valuations. So our conviction on the total returns for CMT is actually higher, it's about 29%. So I mean, we do not really look at all the central malls like SPH REIT, etc. Yeah. Whereas these two REITs that are under our coverage are more, they own relatively larger number of assets, and Singapore-based assets mostly.
You have a question on MedTech. Sorry, this is a big opaque company. We really don't cover. Of course, we know they do personal protective equipment, face masks, gowns. They also do laundry for hospitals. But again, we really have no clue what's going on behind the scenes for this company. We have a question on why Yoma's and our Phillip model portfolio, Phillip Sultan, Chen. While we wait for Chen, let me answer that. Please comment Semcott Industries and Marine. Thanks. Semcott, we really don't cover on Semcott Industries, so fundamentally we can't comment. But on Semcott Marine, I think we've highlighted a few presentations ago on the rights issue itself. It's a very challenged. The share price is challenged. I think. Firstly, the third price for this is about 20 cents. So for those who don't subscribe to the rights, if you don't subscribe, the share price will just automatically drop to 20+ cents. I don't exactly have the exact number because the share price dropped again. Let's say 22, 23. So that's problem number one. And of course, everyone is looking to sell the distributional rights. But if everyone's trying to sell the same thing, then obviously you may not get the price that you want. So that's the number one. That's the first share overhang. So the second share overhang for Semcott Marine is, as you know, it's a bit complicated. But once this whole deal is over, the rights issue is over, Semcott Industries minority shareholders, that means not non-domestic, all Semcott Industry shareholders will get their Sem Marine shares. So your Sembcorp industry shareholder, then suddenly tomorrow the deal over, then the distribution, you get Sembcorp Marine shares. And in total, this minority, excluding Temasek, will own about 30% of Sembcorp Marine. So obviously the first thing, a very high risk that this 30% of Sembcorp Marine shares will be sold in the market. So you got two, like we mentioned before, there's two ways of selling. Those people who don't want the rights issue, and those people who are Sembcorp industry shareholders and got stuck, not say stuck, but were given the Sembcorp Marine shares. And they also might have a propensity to sell. So there's a lot of we just worry that there's a bit of too much overhang on the marine shares, and not to mention the outlook for oil price is also a big challenge. So that is our feedback on the rights issue. That's our worry. Okay. Then in terms of the Yoma, I think Chen is busy or another call.
Sorry, I was muted. Yeah. Okay, so like just to talk about my thesis for Yoma, and then maybe just a brief background. Yoma is a conglomerate in Myanmar, and then it mainly focuses on property, and then it has growing segments in financial services as well as the consumer services, which the consumer part of it, which also includes KFC. So like why Yoma? We actually like that Yoma we actually like that Yoma is actually entrenched in Myanmar's most attractive and fast-growing consumer segments. And then their property land bank has actually 10 to 15 years of sales moving forward. And then their financial services as well is also growing very rapidly and at about 5 times year on year, with a spike in revenue for Wave Money. And then their F&B growth is also underpinned by at least 60% growth in KFC stores over the next 3 years should the economy recover. And I think the last point for this is that as of now, the current price is actually proving to be attractive. And I think about 50+% upside to our SOTP target price of 46 cents. Yeah, so like we see good growth in Yoma. And yeah, that's why we actually like this counter. That's all from me.
Okay, so I'll take the gearing question for Frasers Centrepoint Trust. Currently, as of 30th June, gearing for FCT is 35%, and of course it has been on the rise. I think FCT in the past used to be one of the more conservative REITs/trusts, with their gearing always around like 28 to 30%. So actually, with their interest borrowing rate, cost of borrowing at 2.5%, and we actually do feel that it is and of course they're a heartland / suburban mall operator. So these are more domestic spending, necessity spending driven. So actually we do feel that this usage of the gearing ratio, while it has increased from around 30% to about 35% currently, is actually favorable for them for FCT. There's another question asked about regarding the impact to CCT's price with the merger of CapitaLand Commercial Trust and CapitaLand Mall Trust in September. So yes, the long stop date for this merger is still September. There has been no other info that has been released. Another thing is, I actually do feel that currently at this price, that this acquisition is priced in already. So meaning if you were to ask whether or not which one to buy, which price will go up, actually the price right now, considering the 0.72 exchange ratio and 0.259 cash portion, is more or less priced in already. So in a sense, whatever price movement that was going to happen has happened. So I hope that answers your question. We have one last question about the recent Keppel Corp missing Temasek's MAC precondition. Not sure if Paul wants to take this question.
Well, this answer, I didn't really, I really not sure. This one, I really not sure. But I can only tell you my gut feel that they will still go ahead with it. I think that they obviously, when they do this conditional or proportional kind of a GO, there are obviously some other agenda behind it. I don't think they would just abandon it because of after all, it's still their own company. Yeah. But apart from this thing, Keppel Corp, I know there's another question on Keppel Corp. They're involved in a lot of businesses right now. They're not doing well. In offshore marine, telco. So things are, I'm not sure why anyone want to participate in the company. It's like half of it is not good and the other half is, and 1/3 is doing well. So you're like it's like it's just a conglomerate that's not doing well. It's like running on only 1/3 engine. So I wouldn't touch it. But I still think the conditional rights will go ahead because this is still, they're more or less a related party and they got a larger agenda behind it. Thanks. Sorry, it's not the most comprehensive answer.
Okay, we currently do not have any more open questions.
Yeah, I think we can end it. Yeah. Thanks everyone for participation. And again, if you have time, feel free to attend our listed company webinars. And again, you can always ask any questions you want about these listed companies. Thanks again. I really appreciate everyone taking your time to listen to us and asking questions. Thank you and take care. Bye-bye.